Happy New Year and welcome to our first web conference on the Guide to the Markets for 2026. And today I'm joined by my colleague, Kerry Craig from Australia, who's our senior global market strategist, who shared the stage with me to share with you our thoughts on both the global macroeconomy, but of course, more importantly, what does that mean for portfolio construction? And again, just as a reminder, on top of the Guide to the Markets, we do have the podcast on Investors Minds, which you can get from your regular source of podcasts, but also many of the charts you see today is available on a daily basis. We update this every day, and that's also from a daily guide. So on the screen right now, you should be able to see a couple of QR codes that I'll bring this back towards the end during the Q&A. But feel free to just tap those resources as you try to explain the economy and the markets with your clients throughout the new year. Now, so how Kerry and I will split time is going to be a couple of things. First of all, I'll walk through the global macroeconomy, and then Kerry will walk us through both in terms of asset allocations, but also more importantly, some of the nuances in each of the asset class. So Kerry, thanks for joining us this morning.
Thanks, Ty, and good morning, everyone. Happy New Year. Thank you for joining us.
Cool. All right, let's get on the US economy. I think that's, today is the 8th of January, and frankly, we've had a pretty busy start already with the US action on Venezuela. We've been getting a lot of questions. I'll come back to that topic in just a moment, and the broader implications on sort of the global geopolitics. But of course, I think the market started on a relatively constructive momentum, which is something that we have been anticipating towards the end of last year. But obviously, the key now is whether that growth momentum is sustainable going into the new year, and what does that mean for both the Fed and also the broader central banks around the world. So starting with the US, I think we have ended 2025 with a bit of a moderation in momentum, but I think there's still a fair amount of good news going into the new year, as we've been highlighting for the past 2 or 3 months. First of all, obviously the AI investment boom is ongoing. Again, we can discuss and debate whether that's sustainable in 2026. The short answer is yes. And that to me will be a very key part of keeping up the overall growth momentum in the US. And secondly, the big beautiful bill that was passed last summer, some of these tax rebates, both on overtime, on tips, earnings, as well as some of the other tax rebates, all of that is going to provide a bit of a sugar rush to US consumers going into the new year. So from that angle, I think there's still plenty to cheer about, and that could be a really important factor supporting corporate earnings. But on the charts you see right now on the page, on page 25 of the latest Guide to the Markets, I think the job market is cooling down to some extent. We have on the left-hand side, you can see the number of hiring is reverting back to a more normal level. In terms of layoffs, obviously we're coming off from a very low base right after the pandemic. But again, we're sort of reverting back to a more long-term trend. So we're going back to this of no hiring and no firing environment in the US, which implies from a non-farm perspective, we should be expecting somewhere between 50,000 to 60,000 jobs created on average every month. Now, obviously, this is a touch short on the long-term average of around 440,000, but nonetheless, I think with a shrinking labor force, or at least not really much of a growing labor force because of tough immigration policies, you're likely to see unemployment rate stable around 4.5%. So I think from a Fed's calculus perspective, what that means is that the job market should be looking okay, and arguably there should still be some room for wage growth to take place. So that, I think, despite the recent pickup in jobless rates, we're not expecting a significant deterioration, but more likely to be a relatively slow growth in new jobs created. But at the same time, that being matched by also a slower growth in labor supply going into the new year. On inflation, now, because of the government shutdown, because of the lack of data in October, there are going to be some distortions in the overall numbers. For example, when calculating the shelter costs on rents and owner equivalent rents, there's going to be some nuances that may be artificially understating inflation in the next couple of months. But nonetheless, I think overall you are starting to see some moderation in inflation. I think the low energy costs right now, that's certainly helpful. But also, as you may have read recently, the Supreme Court could be ruling on the reciprocal tariffs or the IEEPA tariffs as early as this Friday. Now, if the Supreme Court does overturn these tariffs, I think there's a lot of these inflationary pressure could gradually dissipate. So overall, we're not expecting a huge spike in inflation, at least for the near term. And again, could potentially allow the Fed to stick with a gradual decrease in policy rates going into the middle of the year. On the next page, on page 16 of the guide, what you see here is that on the right-hand chart, many central banks are likely to be at the tail end of their rate cut cycle. So, for example, if you look at the European Central Bank, here we borrow our the forecast from our colleagues of the investment bank. And what you see here is they think the ECB is done with cutting rates. In the case of the UK, maybe one, at most two more cuts from the Bank of England. But overall, the Federal Reserve, in my view, still have around two cuts to go in 2026. And of course, whether the new Fed chair could introduce more dovishness into the Fed's policy making calculus. Again, that's something we're watching out for. So on a net basis, the interest rate cycle around the world, I think we are approaching the bottom of that cycle, with the exception of Japan, which the Bank of Japan could also be thinking about raising rates further down the line in this year. But overall, we are likely to see interest rates where we are, rather than rock bottom at like 1 or 2%. I think many central banks will be quite happy with where inflation is right now, but at the same time, not being overly aggressive in cutting rates in fear of pushing inflation higher. I think one thing to bear in mind is whether it's in the US or in Europe or in many parts of Asia, the room for fiscal stimulus is still there. As I mentioned earlier, in the US, tax rebates from last year's tax cuts could well support the economy. If you look at Europe, especially in Germany, fiscal stimulus or fiscal spending could pick up, especially in terms of spending more on national defense. So all of these could provide the growth momentum necessary to keep the economic growth going without significant monetary easing by the central bank. So I think from that perspective, we are reasonably optimistic on global growth in 2026, but that still can be achieved without a significant loosening of monetary policy by central banks. Now, on Asia, I think we are entering 2026 with still pretty decent momentum when it comes to exports. So if you look at the PMI data, the latest numbers on page 14 of the guide, or what's on the screen right now, you'll find that markets such as Korea, Taiwan, all of these sort of Northeast Asian markets are still being well supported by demand for AI. If anything, our brand prices have been picking up recently because of shortage, and that again arguably can help to boost the pricing power for lots of Northeast Asian exporters. And that to us, I think is a key reason why not only these two markets have a very strong start in the equity market in 2026, I think the outlook for earnings is also reasonably optimistic, and Kerry, I'm sure he'll touch on that a lot more in just a second. And that to us, again, kickstart 2026 on a pretty strong notes. So, while you may be asking questions about AI, whether there's a bubble or excesses in the US, I think the good news is, regardless of which company comes out on top as hyperscalers in the US, they are all going to need the components and the hardware to drive the data centers and their spending and their capex. And in terms of competition, there's very few competitors when it comes to Taiwan and South Korea. So, for example, on the screen you see on this, on a page you see on the screen right now, is on the right-hand side is a new chart. If you look at, for example, some of the more advanced logic chips, you see that Taiwan and South Korea are really the two key manufacturers. There are very few other markets or countries that are involved in that production. So, whether it is Google or NVIDIA, whether they're building the TPUs or GPUs, even the Chinese, I think they still have to wire through a lot of that production through these two economies. So from that perspective, when we think about the role of AI and how that fits in with the investment themes for 2026, I think the key here is who are not only spade makers are going to benefit, but more importantly, who are likely to have a much bigger moat, a bigger way to protect themselves, protect their pricing power. And that's, I think, where Taiwan and South Korea is in a really strong position. Again, on the same chart on the right-hand side, what you see here, Korea in memory chips is obviously having a very strong leading position, whether it's in design or also in manufacturing. So again, the outperformance of Korea or South Korea in 2025, I think really just a reckoning of that competitive positioning alongside with a number of structural reforms that we see in South Korea, the value program. I think that can, again, sustain that momentum from a macro and the market perspective going into the new year. Now, in terms of China, unfortunately, some of the macro challenges are still very much with us. The property market is still in correction phase. If you look at the charts on the screen right now, on the left-hand side, household appliances had a huge bump in 2025, really on the back of fiscal stimulus. But once that stimulus starts to wear out, you can see that the level of growth, the purple line, dips back quite quickly. So I think what that reflects is that Chinese consumers are still quite wary on spending. If the government provides subsidies or incentives or stimulus, they're quite happy to spend. But without which, I think they will just revert back to a more cautious stance. As I mentioned earlier, the housing market correction is clearly one factor driving that negative wealth effect, but also the job market as a whole, I think is still in relatively sluggish shape. So all of these put together, it means that the government spending and government support continues to be a key part. The good news is on the right-hand side, Chinese consumers and households, they're gradually repairing their balance sheet. So you can see in the last few years, they continue to grow their bank deposits. So they're parking more of their earnings and savings into banks. But at the same time, the gray line shows you that they're deleveraging. So, as the balance sheet gradually repairs, it does mean they do have some purchasing power being restored or ability to invest their cash, which we did see part of that in 2025, but they need that catalyst, they need a trigger for that to happen, and that will require more policy support or breakthroughs in technology in China, as we saw in 2025 with a DeepSeek moment this time last year. And then, throughout the year with the economy gradually adopting more in terms of artificial intelligence. So overall, I think that continues to provide a constructive backdrop for the markets, even though in terms of the macroeconomy, there's still a lot of work to be done by the government to provide stronger footing. Now, so overall, in terms of the macro big picture, we do think the growth outlook continues to be supportive, especially in the first half of the year. Central banks, very few are looking to raise rates, but at the same time, we're approaching the tail end of rate cut cycles in many developed economies. For the Fed, the market's now really pricing in only the first proper cut in the middle of the year. I think that's maybe reasonable at this point. Let's see what the job numbers tells us in the next later this week. But at the same time, we think that fiscal policy is going to do more of the heavy lifting, especially when it comes to Europe as well as some parts of Asia. Now, in terms of currencies, obviously, with the prospects of Fed cuts, maybe there's still a bit more room for the dollar to depreciate. However, I think it's going to be a little bit more difficult to match those 10% depreciation that we saw back in 2025. Ultimately, the US continues to be a very attractive market. And from that perspective, capital flow could still be looking into the US, maybe not just in technology, but a broadening out of different sectors, especially areas such as financials or healthcare or the industrial sectors. But nonetheless, I think the interest rate differential could still keep the dollar on the back foot. And also, you can see on this page right now that the US dollar continues to look a little overvalued, especially against a number of Asian currencies. So again, I think that potential depreciation of the dollar and the appreciation of Asian currencies could potentially attract more capital into our part of the world, which is obviously good news for both the bond market and the stock market. Gold obviously had an excellent run from 2023. Fundamental factors driving gold, in our view, is still very much intact. Central banks want to diversify the portfolio, and the fact that central banks, especially emerging market central banks' portfolio, continues to grow, it means that they will need to continue to buy gold just to maintain that share of gold as a percent of the total reserve. So bear that in mind. Number two, with still fairly high fiscal deficits across the spectrum, across developed economies, I think many investors still want to look for discipline in an asset, which is a theme from our side from 2026. And gold, as I mentioned before, the production of gold, is a very slow. You're adding maybe 1 to 1.5% of gold every year, and that limited supply obviously is good news for investors who are looking to preserve value. And I think that again does imply that gold is in a pretty good shape, and also the fact that again coming back to the Venezuela case in the past couple of days, U.S. foreign policy being less predictable, potentially a bit more volatile in the near term. That again may persuade investors to think more about safe assets, and gold clearly fits that particular category. Even though I've argued in the past that gold is not a proper hedge against risk assets because of the lack of consistent correlation. So I think from that angle, in the long run, next 12 to 18 months, there's still good reason to maintain a position in gold. But again, just as a reminder, it is a pretty volatile asset, so you should size your allocation accordingly. Finally, on oil, before I hand over to Kerry to speak more on asset allocation, Venezuela, 1% of global production, heavy crude. I think that I don't think it's unlikely. I think it's unlikely to change the supply dynamics in the short term. Don't forget, the infrastructure in Venezuela is extremely underinvested, and there are some estimates that it's going to take $50 to $100 billion of investment to get Venezuela back into a proper production mode. So, I don't think this is going to create a supply glut of oil in the short term, which the world, frankly, right now is already in the excess supply mode already. But it's going to take a significant amount of investment, assuming that the policy and political environment in Venezuela start to stabilize. But that also means one thing to bear in mind if you look at the news flow in the last 24 hours is that the US is also looking to tap or trying to pick out ships that are transporting sanctioned oil across the world from Venezuela to Russia or to other parts of the world. And that could potentially create a fraction or a sliver of supply disruptions. And that potentially could provide some upside risks to energy prices in the short term. But as I said, with potential oversupply or actual oversupply in the world today, with sufficient overcapacity in energy production, I think in the short term, oil price is likely to stick around $60. I don't see that being a major inflation threat in 2026. But obviously, as I mentioned earlier, US position on Venezuela, potentially on Greenland, I think all of that could create more volatilities for both the dollar and also gold in the near term. So that's where we are in terms of the macro big picture. I'll just hand over to Kerry to share with us a bit more on asset allocation for 2026, but also more importantly, some of the specific recommendations when it comes to asset class. So Kerry, over to you.
Great, thank you very much, Ty. Excellent outlining of what is a very constructive backdrop to think about allocating towards risk assets in the year ahead of us. We still have a very much a pro-growth view when it comes to asset allocation, a preference for equities relative to bonds, thinking about credit, and still watching duration, but really thinking around its role in terms of where we are with yields and that they're looking a little bit more attractive. And maybe as a role in terms of mitigating some of those risks to growth that could be out there and that volatility that we do see coming through, as you've outlined there, Ty. I think just moving ahead, there's a few things just looking back really quickly to illustrate that last year was another really good year for markets. We saw a 60-40 portfolio that we have in the guide. It was up 15% for stocks and bonds and global equities and global bonds. Better than the 12% in the year before and a little bit down on the year prior to that. But so still a very good year despite all that sort of geopolitical risk we had, the trade war, the tariffs that came through. It really was a lesson in why we talk about staying invested in markets. And I do feel that even though we're having these conversations around geopolitics again, around some of the uncertainty on the fiscal outlook or potentially inflation, it is shaping up to be another good year for markets because we have these quite strong tailwinds behind us when it comes to thinking around that lagged effect of monetary policy or the still easing to come through in some markets, or thinking about that fiscal support that's very much there, or some of these larger secular themes around AI. But as we approach the markets this year, there's three questions that I really want to address. The first is around this regional diversification, the US exceptionalism we've seen for many years now, not holding last year, and really that's an anomaly, or whether we expect that to be a continuation of a trend. The second one is obviously around AI and tech. That's been so dominant over the last 12 months, both in the US and globally, around the preservation or continuation of thinking around AI in a portfolio, and actually where we see perhaps more opportunities coming in other parts of the market, particularly given some of those concentration risks. And the third question really is around those risk mitigation strategies, those hedging strategies. While we do have that sort of pro-growth stance and risk on nature of thinking about asset allocation, we want to ensure we have the appropriate hedges, given some of those risks that are out there, whether it's around the growth or the market pullback potential, or whether it's thinking about the inflation shock that could be out there as well. I think this first chart just grabs that first question around this idea of regional diversification very well. You can see that if we start on the left-hand side of the page, that 10-year annualized return there figure for the US, Japan, Europe, emerging markets, and Asia Pacific, excluding Japan. Over the last 10 years, the US has led. It's been close to 15% return over time. It's beaten all those other markets. A lot of it's coming through that strength in the earnings outlook. And that was very much the case last year as well. So the US, they're up 25%, well ahead of what we saw in Europe and many other markets. And then this year, a reversal. You can see the US still very respectable, thinking about that sort of 18% return there in US dollar terms, but being far outshone by the rest of the world, as we saw a bit of a re-ratings uplift across Japan and Europe and the emerging markets, as well as the effect of that currency and that weakness, about 10% down in the US dollar terms on a DXY, that led to a lift when we think about these returns in dollar basis. So the question is that regional diversification really worked for investors last year. Is that going to continue, or should we see that move back towards the US exceptionalism coming through? I think as Ty's outlined, a lot of that case for thinking about the global economy converging towards a similar growth outlook, and something we'll see in the earnings as well, is one of the reasons we actually do think about the prospect that regional diversification to play through again, particularly again when we come on thinking about the valuation story. So as we head into this year, we still like the US market. It still presents quality. It still has that bias towards some of these big cyclical themes around AI, but we are seeing increasingly attractive opportunities when we think about the growth outlook, the valuation discrepancy between the US and other markets in places like Europe, where you're getting a lot of that fiscal support coming through and potentially a bit more upside to the growth outlook, or whether it's in Japan, we again thinking about the fiscal side of things changing, the movement higher in rates, alleviating some of that fiscal repression we've had for many years, or thinking about how it fits into some of this AI supply chain as well, or even across the emerging world, we've seen what we've seen in Korea, Taiwan, and potentially in China coming through. So it does feel like that regional diversification story is going to be another key one for investors as we move into next year. And I think that's most obvious when we look at the earnings numbers across the world for the coming year. On the left-hand side, we're just showing calendar year expectations for earnings growth for 2025 and 2026 in green. You can see for 2026, pretty consistent double-digit earning growth expectation, and these are consensus figures, not JP Morgan figures, across the globe. So a notable pickup when we look at the Eurozone from last year or in China from last year, and an improvement across Asia Pacific, ex-Japan, as well as in the US. Now, we always have a little bit of caution when it comes to these earnings numbers at the start of the year because analysts tend to revise them down as we go through the year, but it's a very strong starting point. And again, it's about that convergence in the earnings growth, given those tailwinds that we see on the macro front, which really lead into that view around having a more diversified approach regionally to the markets around the world. So again, that lagged impact of those monetary policy easing coming through, even if we don't expect to see a lot more easing around the world, that's still strong fiscal support coming through. And again, things like fading inflation, which is allowing consumption to be stronger and real wages to continue to grow around the world, as well as those secular themes as AI and that supply chain build out does come through as well. So I think, again, we're looking for those opportunities. It is still a case for being an overweight to the US, but we are looking at those relative value opportunities come more through in the rest of the world. Particularly, we've seen some re-rating happen across the course of this year, but still markets like Europe, Japan that are trading at a discount relative to the US market overall. And this is where the rub comes in. It is a relatively constructive outlook for thinking about the performance of equity markets this year, but we've had quite a few years of strong performance from equities, particularly in the US, and valuations have moved higher. So there is this lingering concern there around the fact that we have had an elevated stance to valuations, particularly in the US coming into this year. You can see the US market there trading at 22 times forward P multiple. All country world index at 19 times. These are above average levels. Again, just looking across that top chart there, most markets around the world are a little bit above average when it comes to those valuation multiples. Not all of them, but most of them. So we are starting from a position where we have a little bit more concern around the valuation side of things, thinking about the potential for further lift in those valuations being mitigated to some extent by both the monetary policy outlook and the fact that we have had that come through, but realizing there is a relative value trade in the rest of the world compared to the US. And I think as those earnings numbers show, it does justify those earnings multiples being higher, but it doesn't suggest that they will move up a lot from here. So when it comes to that outlook, it is a case of thinking around valuations do create a drag to those long run returns. But in the short term, it's more the earnings growth, the cash flows that are going to really matter for those performance. I think for me, the thing about the valuations that are most worrisome for the year ahead is if there is something that causes a sell-off in the markets, those elevated valuations can just be an addition to that volatility that we saw. And that was the experience, back in April of last year when we had the tariff news. The things that were highly expensive typically fell the most. And so this is one of the things around the valuations. Not necessarily a headwind to short returns, but more of a challenge around the volatility that it creates when it comes through the market. The second question there obviously is around, if we still like the US, is it still all around the AI theme coming through, and how much should we expect that to change in the year ahead? AI is a secular theme for us. It's something we wrote about a lot in our long-term capital market assumptions. It's something we think can be transformative for the global economy and how things will change around the world. So it is a case of thinking around why you'd still want exposure to these countries. I think it is also a case of realizing that there has been a risk around market concentration. The top 10 stocks in the US now account for 41% of the market cap, and there is a bit of a rise in the valuations. You can see on the left-hand side there, those top 10 stocks trading at a multiple that's elevated compared to the rest of the market. Not elevated compared to its history, but certainly getting up there. Now, I would offset that by saying even though these companies are 41% of the market cap, they are also delivering about 45% of the earnings. So if we take the bottom chart there, you can see the 2025 forecast, that green component, that's the top 10 contribution to that earnings outlook for this year. The gray is the rest of it. And you can see that breakdown is a little bit skewed towards the gray relative to the green. And that's going to change again next year, but they're still delivering on a lot of those earnings. Where we'd be looking for more potential, though, is that broadening out as we think about how we're seeing that shift in terms of the adoption of all of this AI coming through, how the rest of the market's going to benefit from it, as well as some of the other structural changes that may see come through based on policy changes that we may see, or some of those strategic initiatives that come through that would actually support other markets, other sectors in the US economy particularly. So on that narrative, I think when we look at the AI, the big question with AI is obviously around the fact that we're seeing a bit more dispersion within those mega cap names, within those hyperscalers in terms of their performance. That's largely coming down to investors being a little bit more disciplined when they're looking at the size of some of these CapEx numbers that are being spent and planned for in the coming years. It's about $600 billion now out to 2027. And realizing that a lot of this is going to come from cash flows, but some of it's going to come from debt. And we're seeing that performance being reflected if we look at CDS spreads, or if we look at the performance of these companies overall. So the markets are realizing that not every company here is going to end up on the podium at the end of this race, and they need to be a little bit more selective about where they're willing to allocate. There's also this question around the return on this investment. Now, it's going to take a little bit of time for that question to be answered, and certainly when we think about the adoption rates of some of this and look at some of the surveys, it does suggest there's a little bit more ways to go in terms of this being fully adopted and the benefit that could have in terms of revenue generation for these hyperscalers and AI adjacent companies, as well as thinking about the benefits for the rest of the market in the US or even globally. So when we think about that return on investment coming through, it's still a big question that has to be answered. I think we will start to see it more, not from when we think about the subscription services that come through for consumers. It's really about the adoption of businesses that is going to drive this in terms of driving that revenue. And you can see on the left-hand side of this page, the new chart for the guide this quarter, you can see that adoption with paid subscription rate, 45%, it is heading up there. These are surveys, though, so we will take them with a pinch of salt. We do realize that, sometimes when surveys are answered, they're not always 100% truthful and they can change over time. But it does indicate that there has been a good pickup in the term of adoption of AI models and platforms and their tools and use in companies, but it's still a long way to go, especially when we look at across different sectors. And then it's a similar story if we look at the agent deployment on the right-hand side of the page. You can see that, again, you're looking at numbers that are sort of 45, 55%, a good start, but further to go in terms of how these could come through in terms of being the benefit. And this is where we start to think about those adopters of the technology really starting to gain on this basis. So whether it's just impacting the bottom line and becoming more efficient and generating a bit of a revenue outlook in terms of delivering on some of these savings for companies as they come through, that's what we're starting to want to see come through. Or whether it's thinking about some of the other changes that may come through in terms of the data center build out, the need for electricity, the generation that comes with that, the performance of utilities, how the materials sector may also benefit from that, some of the strategic initiatives or defense spending that's been muted in the US, that's going to feed back through in terms of the performance of industrials and materials sectors in the US as well. And then there's other aspects of policy changes such as deregulation in the US, which again could see the financials have another good year in the US market as well. So overall, while we continue to think about AI, its secular nature, the reason to own it in a portfolio, being a little bit more disciplined within the names and those hyperscalers and those top 10 names and how you want to approach it. We're also looking for those opportunities in the other sectors that I just mentioned there. So financials, utilities, materials, industrials, that all start to benefit from some of this adoption, as well as some of those other policy initiatives we see that come through in the US, and a broadening out of that earnings support for the US market. So sectoral diversification as well as regional diversification again, as we think about the performance and equities in the year ahead. Now, if we are thinking about having that sort of risk-on nature in terms of asset allocation, we're again thinking about obviously how we provide balance to portfolios, how we think about some of the strategies that could be adopted to mitigate some of those risks out there and those hedging. Obviously, that can be done on equities, thinking about a focus on equity income strategies, whether it's ones that use derivative overlays or just thinking about higher dividend equity strategies, that income component being a little bit more defensive in this part of the cycle. Or it can think of in terms of just those other assets that would naturally stand out, say core government bonds. And I would say that we have seen a bit of a move higher in bond yields over the last sort of few months, particularly in markets outside the US. We have US Treasuries that are around about 410, 420 basis points. That's within the range that we do believe they would trade. We think they could go up to 4.5, but as they do move up there, I think that's an opportunity to start thinking about adding a little bit more duration to a portfolio, getting a little bit more income to really protect against what could be, a growth shock that comes out, because those yields could fall quite a long way. And in the meantime, you are in fact picking up a decent amount of income from these bonds again. Now, across the credit spectrum, we'd still look at credit in terms of investment grade and high yield. We do think that the income you're getting from those parts of the market are still quite attractive, even though spreads have narrowed, which I'll come on to. But you are getting a decent pickup over treasuries, and we do believe that these are non-recessionary assets that will continue to do well in this environment. And again, it's not going to be a lot of capital gain. It's probably going to be all about the coupon. But again, that return protection, that quality in terms of the investment grade side of the portfolio, can be quite beneficial when thinking about some of those other risks out there. And then on the sort of more risky end in terms of the spectrum, or thinking about emerging market debt, Ty showed a chart that did so that we still expect several markets around the emerging world to continue to cut policy rates. That is supportive for thinking about the emerging market debt cycle. We have a growth outlook that's still quite good, and prospects for a mildly weaker dollar over the course of this year all should be good for thinking about the prospects for emerging market debt as well in terms of income generation for a portfolio. When it comes to the core government bonds, just a word on spreads steepening coming through in terms of the yield curve. This does come back to a big difference in terms of entering into this year compared to last year. Coming into this year, it's all about that divergence in central bank policy a little bit more. So expecting the Fed to continue to ease policy. Many other developed market major central banks are pretty much at the end of their cutting cycle. The UK may have a little bit more to go, for example. Maybe there's a few more across the emerging world. But by and large, it does feel many other central banks are either reached their inflation target, or inflation may be a little bit above where they want it to be, so they won't ease policy further in this environment. And that does mean that they are thinking about the prospects and that divergence in policy, and compare that to where we were last year when it wasn't around the Fed cutting rates. When it comes to the outlook, that does mean we could see steeper curves in the US as we think about the short end of the curve coming down those rate policy outlooks, and the long end of the curve being a little bit more sensitive to, again, what could be a little bit more higher inflation in the short term, as well as thinking about some of those fiscal concerns and seeing a little bit of a backup in yields. But by and large, that will probably play through as we start to see the inflation outlook come down in the US. And we think about, just how far the Fed may go from here and easing policy further, whether they really do go below 3%. So we could see some of that yield curve steepness start to taper out by the end of the year. And so that should give us a little bit more confidence around positioning on the curve. For now, it does feel like in the US case, you do want to be more to the belly, or the shorter end of the curve, rather than the very long end, given some of those fiscal concerns. Whereas we can look around the world and say, take Australia, you're getting close to 4.7% on a 10-year yield. It's pretty good carry coming through. Or look at the prospects of the England. We look at the gilt market. While inflation isn't really behaving there at the moment, we do expect that disinflation to come through, and the Bank of England start cutting rates again. That could be a market we could look for duration. Or even in Europe, again, we're seeing disinflation in train there. Again, the latest inflation print at 2% in the Eurozone that just came out. So I think there's a case for thinking about duration internationally, again, in terms of how we can put it into a portfolio, but being mindful of that divergence in central bank policy being a key driver. And again, yields probably being a little bit more sensitive to growth than inflation as the dominant driver as we look into the year ahead. Now, spreads, as I mentioned, in credit, very tight. We could see a little bit of spread widening come through if there are some concerns around risk, or just simply these large amounts of issuance that's going to come through this year, particularly from some of that AI and CapEx-driven issuance that may come through, or simply because we expect to see a bit more of a pickup in M&A activity overall. So this can support a little bit of spread widening, but again, I think it's the all-in yields that are really attractive when we think about the credit market, and it's that non-recessionary nature of the market. We don't see any of the very large fundamental problems in credit that would suggest you're going to see a very large widening in spreads. There's a significant pickup in defaults coming through in, say, the high yield market. And so we'd be happy to pick up a little bit of carry across the credit spectrum, just realizing that those returns aren't going to be the same as what they were last year, as we just don't see spreads coming in like they did in the year prior. When it comes to the alternative landscapes, I think we are still concerned when we think about the surprise potential from inflation. I mean, it is the thing that I would say is the biggest risk to a lot of this, quite positive narrative. We saw inflation get out of control again, and so that reliving that 2022 experience. And so we do think more around, we can go onto bonds to hedge against that growth risk. We're still looking at alternatives, and many of our clients are looking at alternatives when they think about either the income potential, but the inflation protection they get in real assets such as, infrastructure or transport. or thinking about, where they want to be in terms of positioning for that AI and tech theme over a longer nature when they're looking at what's happening in private credit or private equity, for example. And then on the private credit side, obviously that was a bit of a concern that came through in the fourth quarter of last year. We don't see that as being a systemic risk coming through. I think it is more the case that it would be something that if a recession happened, then we'd be very concerned about what may happen in the private credit market, but not the reversal. I don't think private credit itself is going to lead to a very negative economic consequence for the economy. So we do see that as being something that's becoming more fundamental for lending in the broader economy, and something that's more of a buyer beware in terms of the due diligence that's needed to understand the underlying assets that are actually being bought by investors, and the key to really thinking about the managers that you want to engage with on that basis. So alternatives for us are still very key when we think about both that income inflation protection side of things, but also where you could look for a little bit more growth in a portfolio in terms of what's happening in private equity, given the relatively positive outlook we're seeing for a pickup in exit activity, deal flow over the year ahead, and how they may put in a portfolio, given the relative valuations in the public and private markets a little bit more favorable to the private markets at present relative to the public markets. So I'll wrap it up there, Ty. I think, again, just summarizing that asset allocation view, still very much one of pro growth, thinking about a bit more risk on, being mindful of the valuations that have moved higher over the course of this year and what that can mean in terms of potential additive to volatility, but supportive given the strong earnings outlook that may come through. Picking a path through the market really does look at thinking about those relative value opportunities in sectors outside of tech in the US, so financials, utilities, materials, industrials. And again, that broader theme around global diversification did work this year, and we continue to think it will work next year. That hedging that off in terms of being a bit more active on the duration exposure front, as we see central banks play through that monetary policy path through at the end of the year, and still liking credit for their carry that's unavailable, given we don't see the downshift in the global economy and spreads remaining relatively tight.
Excellent, Kerry. Thank you so much for that run through. There's a lot of ground covered. I think, absolutely, in terms of the risk on or the more pro-growth backdrop continues to be with us. But I think just to highlight a couple of things. One is that the importance of rebalancing is still there. If you have not rebalanced your portfolio for the past couple of years, your traditional 60-40 US stocks treasury portfolio would look more now like 70-30, and therefore maybe deviating away what your risk allocation should be. The other thing, as Kerry rightly mentioned, is the income generation, which we think is going to be more important. While we are pro-growth and pro-risk, I think it's natural to expect a higher level of volatilities and maybe a bit more moderate return from equities over 2026. So the income contribution will look a lot more relevant to most APAC investors. Thank you so much for your time, and Kerry, thank you so much for joining us as always. Very insightful comments on asset allocation, portfolio construction. Of course, any follow-up questions, please let me, Kerry, and our market strategist or your client advisor, JP Morgan Asset Management, know, so they can give us the questions and we get back to you. As always, we have our on-demand investors, both in terms of publications, but also the podcast. The QR code's right there. And if you have any questions, please don't hesitate to let us know. Wishing you a fantastic, prosperous, healthy, successful 2026. It's going to be very volatile. It's going to be very choppy. It's going to be very noisy, just like last year. But we will be with you every step along the way to give us our thoughts and insights on how to work on those challenges. We will see you in the next round in, I guess, I think 2 weeks or 3 weeks time with the next FOMC meeting, where we will breaking down for you in terms of what we think the Fed is going to do in the months ahead. So thank you. Thanks, Kerry.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.